Small company stocks have had a great run, but that may be coming to an end. I'm Jack Otter, editor of BARRON'S.com. I'm here with Brendan Conway, who writes our Focus on Funds blog. So, Brendan, you had a post that I found very interesting about how small cap stocks have done so well in recent years. 5 years of beating the big caps. Last year was a great year for small caps, but recently that tide seems to be turning.
Yeah, Jack, over the last several weeks, smaller size stocks have started to fall behind and so-called mega caps. This means the biggest stocks of all, like Exxon and Microsoft, have started to pull ahead. Really, that really so far is shaping up to be a theme of this year of 2014, a year that's turning out so differently than 2013, where there's a little bit more caution out there. Investors do tend to view those larger companies as kind of safer, quote-unquote safe, as opposed to the smaller ones.
Safety seems to be a theme. I mean, they're running away from the glamour stocks, the Twitters and the Teslas and all that. So I guess it makes sense they'd also leave those riskier small caps for the big guys. Can you put this in a broader context for us? Often coming out of a bull market, coming out of a bear market, in the early stages, it's those little growthy companies that do really well. And then as the bull market matures, people tend to gravitate toward those more blue chip type companies. Do you think we're in that phenomenon right now?
Jack, I would tend to think that 5 years in, something like that, will probably happen from here. And that was the feeling this morning at Bank of America Merrill Lynch, where their market technicians were arguing that, yes, this transition is now taking place. The other way to look at it, too, is growth stock investors are looking for growth and growth and growth and strong earnings. A value investor looks for a cheap PE multiple. And lately you have also seen value stocks take leadership, which is interesting. That often goes hand in hand with the large size.
That reminds me of another post you had based on a Larry Swedroe column. Swedroe argued that this value premium, it made famous by Warren Buffett, that might not have the future that it did in the past. Can you explain that argument?
Sure. So value, meaning basically buying stocks that are attractively priced, has had a great history. You can go back decades and say that if you just bought the cheapest shares and kind of hung on to them, you would have beaten the market. The thing to keep in mind here, though, is that Warren Buffett has famously said that his favorite holding period for an outstanding company is forever. And really, that's often the mindset that you need to take, because value stocks can get destroyed in a sell-off. And in fact, that's what happened in 2007, 2008.
It's called the value premium, this idea that you do get paid for it. But as Swedroe points out, and it feels counterintuitive, he says that the value stocks are actually riskier. That's why they have a premium. And one thinks of value stocks as safer, but as you point out, not necessarily.
Not necessarily. And also, folks should also keep in mind that the more that investors are aware of a given strategy, and the more they like it, the more likely they are to use it and to buy it up, and then all of a sudden it could vanish.
That's a crucial point. Academics figure out some anomaly in the market, the hedge funds jump on it, and it disappears because they've jumped on it. We should never assume that what worked in the past is going to work in the future.
Could happen here.
Thanks very much, Brendan.
Thanks, Jack.